Gold is doing well. It's hanging in there despite the constant doubters, and they are abundant, even among the gold bulls. And I would say that this next upturn that we're probably on the cusp of right now, the next daily, weekly upturn, could be the one that engages us. And I would give you a number. You get much back over 2,100 gold again? Expect it.
In a recent interview with Liberty and Finance, MichaelOliver from Momentum Structural Analysis discusses the potential for the following daily and weekly upturn in the gold market. Oliver specifies a critical price level, noting that if gold surpasses $2,100, it is expected to perform well. Despite minor reactions to significant data releases and corporate earnings reports, gold prices exhibited a narrow $10 range between $2,016 and $2,025 last week. Adrian Day, president of Adrian Day Asset Management, anticipates a boost in gold prices in the upcoming week, attributing this expectation to moderating inflation numbers. Day suggests that the likelihood of a Fed rate hike in March has increased, which, in his opinion, will contribute to higher gold prices. Oliver comments on the market dynamics, indicating that the recent selling has not resulted in a significant decline, but has stabilized the lower $2,000s. Despite this stabilization, the gold market experienced a sharp sell-off following Thursday's housing data release. The price fell to a daily low of $2,016.23 in the minutes following the 10 a.m. EST release. As of the latest session, spot gold last traded at $2,018.75 per ounce, showing a 0.11% decrease. Oliver acknowledges a banking crash in the spring, emphasizing that gold responded differently, showcasing its ability to foresee events. Over 5 days in March 2023, 3 small to mid-size U.S. banks, including Silicon Valley Bank and Signature Bank, experienced collapses. These events, considered among the largest U.S. bank failures since the Great Depression, raised concerns about a potential widespread banking crisis. Gold and silver prices surged in response to the crisis, benefiting from their safe haven appeal as investors sought refuge. Spot gold experienced a significant jump of 2.44%, reaching $1,921.63 per ounce, the highest level since early February. U.S. gold futures also gained 2.6%, settling at $1,916.50. Join us as we delve into insights shared by MichaelOliver. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Gold market had that surge December 3rd or 4th, the first day of the December, where you went up and finally hit the stops, the buy stops, no doubt, shorts covering their losing positions, late longs coming in at 2,100. Okay. And you gushed within 45 minutes up to 2,150. Why? Because it was in the dark. 2, it had to be a massive amount of buy stops there. And so they were elected and it just whooshed. Okay. But once all that buying dissipated, literally within that first hour, it was probably a void below. And so anybody who came in and sold, and I think the BIS actually did sell, dropped it immediately back down. And within 6 days of that high, gold traded down to 1980. Since then, gold launched back up to the upper 2000s and has never taken out that 1980 low that we made 6 days after that high. So you could basically take early December, second week of December, and we've been caught in between since then. A lot of selling, but this time, unlike last year, March to October, where it went down, a couple $100, or that 2022 drop, it dropped 20%. This time, the selling has just created wheel spinning. And I think the bears have run out of the clock. I think, they needed to do more than they did. And all of a sudden yesterday, if you'll notice, while gold is still spinning here in the lower 2000s, silver shot up $1. Very interesting, very curious. And the miners have begun to stabilize again. Of course, they are always lagged to gold. At some point, they won't be. So pay attention to that. We measure that and we issue that in our reports. But I think gold is doing well. It's hanging in there despite the constant doubters. And they are abundant, even among the gold bulls. And I would say that this next upturn that we're probably on the cusp of right now, the next daily, weekly upturn, could be the one that engages us. And I would give you a number. You get much back over 2,100 gold again? Expect it. If this government data point does this, gold will sell off. Gold has been around 3,000 years. Okay, UST bond's been around, what, 100 years, something like that? And the stock S&P's been around since the 1950s. Okay, it's an old and wise market. It's always been money. It still is. It anticipates macro events. It doesn't wait for headlines. And yes, you're right. Back last spring, the banks had a crash, literally a dimensional crash where in a number of weeks drop 30-something%, that's a crash. We called that in late January. MSA had a technical reason. We didn't explain why. We didn't know why, but we could see they were going to collapse. And they've been an outperforming sector then. We're talking early 2023 now. And sure enough, in February, March, they hit our trigger numbers and crashed. Since then, we've had this crawl back based on, the Fed's going to take care of things. Don't worry about it. Okay, well, we'll see. Meanwhile, banks aren't back at their highs. Okay, they're not doing what the S&P's doing. So we're watching them very closely. And Brett's observations are dead on. This is a real problem for the Fed. They can't have another bank crisis, meaning their only alternative is to liquefy again. That's what gold ultimately responds to, is the degradation of the money unit, meaning the liquefaction of the system. And so gold knows that. And that's why even though banks have rallied, gold has not caved. We had a good surge into early 2023 and then this protracted pullback. And now we're sitting up there. How come we're still sitting up at the highs in gold, basically, while the banks have had a rally? Gold knows better. It knows the bank rally is not sustainable. And I would also watch the broader financial sectors as well, not just the banks. I know everybody's looking at that, but watch for example, XLF is a good ETF to watch for the broad financials. But the Fed is very nervous about this. They have to be. And the other thing they're nervous about is their T-bond market. It crashed last year. We called the nuke event, and sure enough, in August, September, October, the T-bond market went down in a crash mode. Rates went up to new highs, took out the price low of October 2022 vastly in October of 2023. There was an uncontrolled decline, and that had to panic the Fed. And I'm sure they probably came in and helped support that market in the dark. But now that market has already given back a third of its gains, price gains, T-bond market. They got to get a little antsy right now. So what does that mean? Well, if they get antsy, that means somewhere down the road here, probably sooner than you think, data points or no data points, they're going to have to re-liquefy. That's what gold knows.
The momentum of U.S. stocks witnessed a shift on Friday, as both the S&P 500 and NASDAQ composite ended lower, marking the conclusion of their respective six-day winning streaks. While the S&P 500 had recently achieved 5 consecutive record closes, the broader market indices, including the NASDAQ 100 and S&P, reaching new highs, were not without concerns. MichaelOliver highlights that the significant contribution to this success comes from a select group of tech giants like Apple, Microsoft, and NVIDIA. The recent market boost was attributed to the monthly PCE data, indicating that the Federal Reserve's preferred measure of core inflation had decelerated to its lowest level since the spring of 2021. However, MichaelOliver emphasizes that despite the positive market sentiment, there is a notable concern regarding the exceptionally narrow breadth of the market. The reliance on a select group of key stocks for driving overall market performance raises questions about the robustness of the current bullish sentiment. Against this backdrop, the Vanguard survey in December revealed that investors anticipated a 5.7% return on stocks over the next 12 months, showing a 1.3 percentage point increase from October. Let's get back to the interview.
It's entirely extremely limited leadership. It's mostly tech, almost all tech. In fact, it's a narrow segment of the tech sector that has made all-time new highs. In fact, if you look at XLK, which is the tech ETF, only 25 of the 61 stocks at our last measurement have made a new high. So even only about a third or 40% of that tech sector has marginally taken out the 21, 22 highs. NASDAQ 100 has nipped it out by a couple percentage points. No big deal. It's 2021 high. S&P has only marginally taken out its high by a percent or two. But when you look within the indexes, you'll see the stocks that did it are like Apple, Microsoft, NVIDIA, and when you go, I suggest to all your listeners and watchers that they go to their quote screens and type in a bunch of ETFs of sectors within the S&P that aren't tech. Example, XLP, consumer staples, XLY, consumer discretionary, which used to be a leading sector all during the bull market from 2009 to 2021, it's only 2/3 of the way back to its high. Look at retail, XRT. It's laying there dead comatose, 50%, 50% back toward its high, but just comatose. Despite all the talk we hear about, oh, the consumer is strong. If you look within the stock market, you'll see it is exceptionally narrow, and that is not good for the bulls. Plus, our technical assessment of the leading stocks and the minor tech sectors that are leading this is that they're extremely vulnerable for a downturn. They're in what looks like a blow-off type mode. And when those things turn, they often turn savagely. And we're trying to measure that, the timing of that. And if you look at the other sectors and you say, well, how's my retirement account doing? Well, if you're in NVIDIA, it's doing well, okay? But you've got to be in half a dozen stocks to be outperforming the level where MSA said, be gone. Every index out there, except a few stocks within the S&P, heavily weighted in NASDAQ 100, for example, and the tech sector, have taken out those highs. But you had to wait 2 years for that to happen, okay, to finally get back up to where we said get out. But most sectors are well below that level. So the stock market in general, if you really want to put quotes around stock market, it's not back to where we said exit. And I think once the tech sector has its little bubble popped, and I think this is a temporary bubble. It's like, for instance, if you look at NVIDIA on a price chart, there was this big surge up to $500, and then this range, multi-month range, where there was sellers, and it was capped, what we call a distribution range. So there were doubters taking their profits, who got in well, But then we burst beyond that up to 600. And when you look at the price chart and use orthodox analysis, you think, oh, that was a range, that's a midpoint range for a swing move. No, it's highly likely to be a bull trap. In other words, that distribution range was a valid indication of smart money moving out. Now, the late money is spiking it up briefly. It's only a couple of weeks now, by the way, above that level on NVIDIA, for example. If you abort back down into that price range, watch out. The downside could be very rapid. And we've got some momentum metrics that will be triggered even before you get back down, let's say, into the 500s on NVIDIA. And a similar situation on a lot of the tech stocks as well. So they're very dangerous. It wouldn't take a sneeze for them to really drop sharply. And if they drop, we all know what's going to happen. They will take the market because they're the metrics that have caused the market to come back up. Okay. So I think it's a very dangerous, pivotal situation here.
Frank Cholly, senior market strategist at RJO Futures, anticipates a prolonged period of sideways price movement in the gold market. I think the gold market is just marking time here above $2,000, Cholly said. It's hard to see basing the bottom at this level, but basing a base. I think the Fed is more likely to hold higher rates for longer than to cut right away. I don't think that bodes well for gold necessarily, but I do think that technical levels are important, and maintaining levels above 2,000 is somewhat positive. How might the Federal Reserve's stance on interest rates impact the gold market, considering the potential for a prolonged period of sideways price action? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.